Almost no one is ready for how disproportionately XRP is positioned to benefit from the enormous end-of-year market eruption that most analysts are currently predicting. We are witnessing circumstances that the market has never experienced before. At the same time, supply drain, macro liquidity, ETF acceleration, institutional demand, legal certainty, and geopolitical alignment all converge. This year, a lot of analysts are publicly advocating for three-digit values, and it's hard to be pessimistic when you look at the statistics, the on-chain figures, the institutional flows, and the macro triggers. By the end of this video, you won't have any doubts about what's ahead for XRP because everything points to the same conclusion. The early investors will be the ones to witness what happens next as XRP is poised to enter a whole new chapter. Hello and welcome back, everyone. I hope today is going well for you all. If you enjoy discussing Ripple and XRP, your step-by-step roadmap to transformative wealth, or subscribe to Pro for full access and exclusive weekly insider reports to find out exactly how the top 1% are now positioning. The general public now has a basic misconception about XRP, which is precisely why institutions are covertly acquiring at a scale that retail still doesn't understand. XRP is not a business. There is no CEO for it, like corn, oil, and silver. It is a commodity. Furthermore, there are no set prices or ceilings for commodities. They shift in response to global demand, supply, and utility. Additionally, XRP is about to enter a phase in which all three are aligning more quickly than anyone anticipated. Commodities are not limited by market capitalization. The world's need for the train, the amount of liquidity that passes through it, and the scarcity of the circulating supply when actual institutional players intervene are what define value. For this reason, organizations are considering XRP rather than the hundreds of altcoins that lack a solid legal basis. For a single, straightforward reason, Cointelegraph has already published articles demonstrating rising spot XRP ETF filings. Clarity of law, almost no other significant altcoin has what XRP does. Regulatory assurance, institutions aren't searching for hype currencies either. They are trying to find rails. They are searching for layers of settlement. They are searching for high throughput, internationally accessible, highly liquid assets that reduce financial system friction. XRP is that. With well-known names, Ripple has been constructing these rails for more than 10 years. Standard Chartered, Bank of America, PNC, and numerous others under NDA. These organizations are aware of XRP's capabilities, they are aware of its potential. Additionally, they are aware of what its regulatory clarity enables them to accomplish. However, a lot of them are still awaiting the last component, liquidity and macro circumstances. Furthermore, the time couldn't be more ideal. The most significant macro catalyst is currently taking place. The last day of quantitative tightening is December 2nd, 2025. The balance sheet reduction program of the Federal Reserve, which has been depleting the system's liquidity since mid-2022, is formally coming to an end. As soon as QT ends, markets relax, liquidity starts to reappear, and risk assets often soar. Indeed, there is still a correlation between XRP and macro liquidity, whether you like it or not. Crypto increases when the Fed eases, crypto cools when the Fed tightens. Just stopping QT is a powerful catalyst. It's not the only one, though. We are about to enter a time where policy is pushing markets higher. Rate reductions are anticipated. Spending on AI infrastructure is approaching $1 trillion annually. In 2026, corporate buybacks are expected to reach $1.2 trillion. Tax reduction and stimulus are major political pledges. High-utility digital assets are being favored by liquidity flows. Additionally, the demand for ETFs is growing more quickly than anticipated. Supply shocks are caused by this. On open exchanges, buyers of spot ETFs are not purchasing XRP. Since they are purchasing through private transactions and over-the-counter, the buying pressure has not yet reached the public charts. The supply drain, however, does. ETFs will be compelled to purchase from exchanges if the OTC inventory vanishes, which it will. Price revaluation gets explosive at that point. Furthermore, the exchange supply itself is startling, not $4.2 billion. Despite what some posts say. According to new Glassnode data from November 29th, XRP was worth $2.6 billion, or $6 billion. Once ETF inflows are available on the open market, that sum might be consumed in a matter of weeks or even days. This is the exact appearance of a supply shock. And that's why those who understand liquidity mechanics don't find three-digit estimates implausible. Tom Lee and other conventional market analysts are predicting a strong year-end rally. His logic? The Federal Reserve's turn. Restoring liquidity, reversal of sentiment, managers of funds are well behind benchmarks, and improving the visibility of earnings. People experience FOMO when liquidity returns. In cryptocurrency, FOMO is vertical as well. Imagine FOMO entering a market where XRP, the leading legal cleared asset, has the lowest exchange supply in years. The setup is as follows. However, the ETFs aren't the largest catalyst of all. QT isn't coming to an end. Institutional demand isn't even the issue. It's far more significant. The Clarity Act. After this is approved, XRP will be the first digital currency with institutional rails that are entirely compliant and within the most powerful financial authority in the world. Over time, that alone generates trillions in liquidity. I'm long-term bullish because of this. For 4 or 5 digits, I'm here. December alone, however, has the potential to produce moves that most people still undervalue before we reach that point. The fact that the financial industry is being completely reconstructed is the aspect of this change that is most often ignored. Accounting, messaging, liquidity, settlement, and payments. Everything is being improved. Furthermore, the speed of contemporary international trade is simply too great for institutions that were developed decades ago. Blockchain settlement rails are therefore required. They are necessary. This is perfectly framed by the Clarity Act. It characterizes a financial system that is quicker, less expensive, more equitable, transparent, and free of middlemen. It describes a world in which payments are made quickly, around the clock, a society in which mistakes are not hidden, fees are transparent, and transactions can be tracked. A world in which information is as fluid as liquidity. XRP was designed with this scenario in mind. Furthermore, the future isn't solely focused on cryptocurrency. It has to do with the American financial system itself. New businesses, industries, jobs, and capital flows are all produced by the new tracks. Financial rails transform everything they come into contact with, much like roads, electricity, and the internet. America's competitiveness in the world increases. The dollar gains respect, strength, and stability. And through accountability and openness, the faith that has been lost to the system for decades starts to reappear. For this reason, governments, banks, and sovereign organizations are researching the structure of XRP. It provides something that no other digital asset can match: decentralized liquidity with supervision structures that are prepared for compliance. The valuation ramifications are enormous if XRP reaches even $250 and Ripple and the US Treasury each own 17% of the cryptocurrency. Assets of billions of dollars that are on par with or greater than those of the world's biggest financial firms. The speed at which the larger macro environment is changing in favor of XRP is one factor contributing to the unusual nature of this moment, more quickly than in the previous 10 years. Institutional pipelines that had lain dormant for years are now warming up at a rate that most people are just unprepared for. Liquidity is returning, risk appetite is returning, and regulatory clarity is building. It's also critical to realize that when everything appears to be going well, markets hardly ever move. When circumstances change, they migrate. Right now, that pivot is taking place. Major financial institutions are starting to recalibrate after years of hesitancy, and each recalibration comes to the same result. The upcoming financial cycle will be dominated by digital assets with practical applications, and XRP is ranked first on the list. You'll see that what's coming together is not random if you look at the current situation. It is structural. Rate reductions, the end of quantitative tightening, trillions in corporate buybacks, the growth of AI around the world that necessitates instant settlement layers, the scaling of institutional ETFs, and the Clarity Act driving the U.S. toward modernity. A multi-year liquidity surge is the natural result of all these forces coming together. There have always been winners and losers from liquidity surges, but this time, the winners won't be dead-end tokens or meme currencies. These assets will be positioned as global settlement rails. That is the fundamental distinction between structural adoption and narrative exploration. Adoption that is structural has longevity, compounds with structural adoption. Global footprints are produced by structural adoption. This kind of setting is ideal for an XRP with a 10-year foundation. It is clear why XRP is unique once you examine the mechanisms underlying institutional behavior. 99% of the market still lacks XRP's extensive liquidity channels, institutional corridors, internationally dispersed validator network, court-solidified legal underpinning, and track record of settlement efficiency. Because of these factors, XRP is stacking ETF filings more quickly than almost every other altcoin. It's not a case of luck. It's also not a coincidence. It's time for the preparatory meeting, and now is the right moment. One of the most important but often ignored drivers is the supply dynamic. Charts are examined by retail investors. Organizations examine their inventories. Additionally, the amount of XRP that is currently available is decreasing at a rate that most analysts aren't accurately predicting. On the back end, OTC transactions are depleting institutional supply. Exchange balances, meanwhile, are still declining and have reached multi-year lows. You're basically witnessing the early phases of a supply crisis unfolding in real time, as there are only a few billion XRP remaining on exchanges, and it is decreasing every week. This is how supply shocks develop, slowly, silently, and imperceptibly, until the market abruptly recognizes that there isn't enough to go around. Price discoveries turn severe as buying pressure moves from over-the-counter to open exchanges. Minutes, not months, are when markets reprice. Every historical commodity spike has experienced this tendency. Additionally, XRP is following the same trend. Beyond the supply, it is important to pay attention to world events. Laws pertaining to digital assets are being advanced in dozens of nations. Cross-border settlement procedures are being tested by central banks. Additionally, in order to shorten settlement times, global firms are implementing ledger-based solutions. The world's financial infrastructure is being upgraded. And for more than 10 years, XRP has been incorporated into this story. The phrase neutral bridge asset is used by institutions for a purpose. They're not talking about Ethereum or Bitcoin. They are speaking of assets that are tuned for global throughput, compliance, speed, and dependability. XRP was not intended to be a tool for speculation. It was intended as infrastructure for settlements. In other words, adoption doesn't trickle, but rather scales. Banks, payment behemoths, and entities at the sovereign level assess what settlement needs in the future. They require assets that satisfy very stringent requirements. They require decentralization. They require dependability. They require liquidity. They require clarity in the regulations. They also require worldwide neutrality. One of the few assets that meets all requirements is XRP. The Clarity Act and related international frameworks are crucial for precisely this reason. They eliminate friction, not because they are regulatory news. Institutional flow can quicken if friction is eliminated. Additionally, the market structure shifts from speculative cycles to permanent liquidity channels when institutional flow picks up speed. This change is what distinguishes mature global settlement ecosystems from early-phase cryptocurrency markets. It is no coincidence that Ripple is associated with some of the world's biggest corridors. Financial institutions such as banks do not haphazardly experiment with new technologies. They thoroughly test, assess, and put pressure on anything before implementing it that involves actual money. There is no indication of doubt in the NDAs, pilots, or collaborations. These indicate moving infrastructure. These institutions come into action in large numbers once the macro environment permits risk-on growth. Liquidity then floods into the corridors that have previously undergone testing, validation, and proof. Once more, XRP has a structurally unfair edge in this situation. It's not brand new, it has been tested. It is not uncontrolled, it's prepared. Most retail investors believe that a liquidity wave indicates an increase in price when macro analysts discuss it. Institutional liquidity waves, however, exhibit distinct behavior. They don't seep upward. They strategically flood. They search for tracks that can manage needs related to size, speed, and cross-border travel. This is the case with XRP. Furthermore, XRP's goal is already in line with trillion-dollar flows in a market where the majority of tokens are still attempting to explain why they exist. The catalysts are stacking more quickly as we move into the following stage of this cycle. Risk markets are fueled by rate reduction. Liquidity expansion is fueled by QT ending. Institutional pipelines are created by exchange-traded funds. Bottlenecks are broken by clear regulations. Buybacks by corporations have a wealth-enhancing effect. Spending in AI infrastructure generates settlement demands. Capital is driven into hard and semi-hard assets by deficit growth. Each of these forces amplifies the others. In the middle of their intersection is XRP. The intriguing part is that most individuals won't notice this moment until it has already occurred. Major macro developments always unfold in this manner. Early in the process is the calm accumulation phase. Midway through the cycle is the disbelief phase. The emotional stage occurs close to the summit. However, institutional underpinnings are established during the structural phase, which we are currently entering, and all that comes after is determined by foundations. What's going on behind the scenes is considerably more significant than the daily chart's price action. As we move farther into the next wave of adoption, the price lags behind the fundamentals. The fundamentals are already changing. Institutions are setting themselves up Frameworks are being updated by governments, the amount of liquidity is growing, technology is growing. Additionally, settlement rails are starting to form the foundation of the upcoming financial generation. This isn't financial guidance. We are no longer dealing with theoretical adoption or speculative forecasts, which is what sets this phase apart from other cycles. We are currently seeing the development of a new financial systems architecture. All the key indicators suggest a once-in-a-generation change in the way institutions manage settlements, the flow of liquidity, and the movement of wealth across borders. Additionally, digital assets aren't being neglected for the first time. They are being immediately incorporated into business, banking, and sovereign infrastructure. XRP didn't just happen to show up at this time. It was developed, tested, litigated, improved, and positioned for a future that the rest of the world is only now beginning to realize for over 10 years. The combination of macroeconomics, technology, and timing offers XRP a structural edge that most people still don't realize. The majority of assets depend on hype cycles. They need to be noticed. They are narrative in nature. XRP depends on usefulness. It is essentially different just because of that. Utility becomes the ultimate filter at scale. It distinguishes assets having long-term value from those created for speculative purposes. A system becomes necessary when liquidity flows through it because it must, not because people want it to. And that's precisely what XRP's design as a bridge asset is, vital. XRP becomes increasingly important as the world gets more digitalized, cross-border settlement gets more automated, and immediate liquidity routing becomes the rule rather than the exception. Retail traders transferring $200 across exchanges is not what we are discussing. Hundreds of millions, if not billions, are being moved in real time by banks and other institutions with almost 0% failure rates and little friction. Simply said, the legacy system wasn't designed for it. XRP was. The institutional recognition that traditional payment rails cannot sustain the speed of contemporary economic activity is a significant change that is currently taking place. Millions of microtransactions will be carried out by AI models per second in the future. No human desk can match the speed at which autonomous systems will trade, settle, and balance liquidity. Across continents, supply networks will depend on real-time inventory management. To lower error rates and do away with expensive reconciliation procedures, financial markets will require stable, transparent settlement layers. What asset can settle value quickly, universally, compliantly, and without any one jurisdiction having exclusive control? That is the question at the heart of all of this. Bitcoin is unable to. Stablecoins are unable to. Most altcoins are unable to. XRP is able to. The geopolitical aspect becomes crucial at this point. Countries are searching for neutral digital rails that don't need them to rely on competing jurisdictions as international tensions grow and financial competition heats up. One of the few assets having that neutrality ingrained in its constitution is XRP. Its verified network is dispersed throughout the world. Its governance is independent of any one country. Its ledger is designed to be as fast, dependable, and economical as possible. More significantly, it is the only significant digital asset with a legal framework that is directly compatible with U.S. financial institutions, thanks to its legislative base in the U.S., the Post-Clarity Act. It is quite uncommon for neutrality and regulatory clarity to coexist. It puts XRP in its own category. Liquidity will be the focus of the upcoming 10 years. Power comes from liquidity. Which networks grow, which assets endure, and which financial platforms are dominant are all determined by liquidity. The more volume there is, the more useful XRP becomes. The more it is used, the more effective it becomes. In contrast, most systems experience congestion, which causes everything to slow down. Adoption is accelerated when trillions pass through a system designed for billions. For this reason, sovereign entities are researching the liquidity mechanisms, settlement finality, and throughput of XRP. Crypto is not what they are searching for. The foundation of a new financial settlement architecture is what they are searching for. Nevertheless, the market continues to underestimate the scope of what lies ahead in spite of all of this. Charts, lines, and short-term cycles are how most investors think. Institutions consider competitive advantage, infrastructure, cost reduction, and efficiency. Institutions never take something halfway when they accept it. They fully embrace it. Legacy rails are rendered obsolete once using XRP rails to transfer money becomes more affordable, quicker, and secure. Furthermore, history demonstrates that capital does not gradually disappear when something gets outdated. It all evacuates at once. This is how changes in technology happen. After years of feeling slow, they suddenly become inevitable. The form of institutional concealment is another crucial issue. The most busy phase is always the calm one. Banks don't disclose the assets they're acquiring, the pathways they're preparing, or the things they're testing. Until the infrastructure is prepared, NDAs keep everything private. Additionally, the market responds immediately rather than gradually when it is eventually made public. This explains why scholars of institutional behavior are so optimistic about XRP. They are aware of how these cycles develop. The underlying asset reprices to reflect its new role as soon as institutional systems transition from testing to deployment, as demonstrated by decades of history. Furthermore, the amount of the repricing increases exponentially given that the exchange supply of XRP is at all-time lows. An excellent illustration of timing in line with structural changes is the termination of quantitative tightening. Markets don't just bounce after QT ends, they use leverage again. When liquidity returns to the system, all of the major asset classes have historically rallied. However, assets that are situated at the forefront of technological advancements tend to rally the most. XRP is situated at the nexus of cross-border finance, AI, payment, and sovereign liquidity infrastructure. That isn't a specialty. That is the fundamental aspect of the global financial system. That, along with regulatory frameworks, corridor activation, declining supply, and ETF demand, creates a situation that has never been present in any prior market cycle. Blockchain used by institutions is not a fad. It's essential. For traditional rails to endure unaltered, costs are too expensive, settlement is too slow, compliance operations are too inefficient, and global commerce is too linked. The world is undergoing a real-time rewiring, and XRP is not pursuing this change. It's making it possible. Today's rails will be in use for many years to come. The assets selected today will serve as the foundation of international finance for a whole generation. Furthermore, short-term volatility becomes meaningless once you grasp the magnitude of that change. Positioning is the only factor that counts. The largest obstacle that most investors will encounter as this shift progresses is skepticism. The scale is so big, not because the data is ambiguous. People are indoctrinated to anticipate minor results. However, the change that is taking place is significant. It is inevitable, structural, and worldwide. The organizations getting ready for it are aware of this. Early adopters are aware of this. Those who have researched the architecture of XRP are aware of this. If you want the specific wealth blueprint that early adopters are employing and the step-by-step plan to position yourself before this shift accelerates,